Simon Property stock, ticker symbol SPG. Is this the best REIT to buy right now? This stock is down 12% on the year-to-date chart, while the overall market, in this case the S&P 500, is up roughly 10%, so that's a big difference. On the 2nd of May, Simon Property presented quarter results where they beat on FFO and revenue. For the upcoming earnings, all 11 analysts expect a miss, so that's very interesting. From a dividend point of view, things look pretty interesting with dividend yield at 7.2%. But there's almost no growth in the past 5 years. And does this mean that SPG stock is a buy at current prices? Well, in this video I'm going to show you real quickly what Simon Property does. The earnings report, the fundamental analysis, dividends, returns versus the S&P 500, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Simon Property do? Simon Property is a real estate investment company focusing on traditional malls, premium outlets, mail centers and outlet centers, and big box retailers, lifestyle centers and 5 other retail properties. When we dive in the most recent earnings report, we see that net income was reported at $451 million or $1.38 per diluted share, compared to $426 million or $1.3 per diluted share in 2022. So you have a small increase there. One of the most important numbers, FFO, increased to $2.74 per share versus $2.7 last year. Again, a small increase. And it's the same story with the NOI. It increased 4%, which is again nice, but not the highest amount. Occupancy rate was at 94.4% versus 93.3% last year, so this is looking good. And the base minimum rent per square foot increased 3.1%. Dividends were increased 15 cents or 8.8% year over year, which is very nice of course. The 2023 guidance looks also pretty interesting, with a low end of 11.8 estimated FFO per share and a 11.95 on the high end. And in here we see a more detailed view of the FFO numbers. With dividends sitting at 1.58, we see that they easily covered with the FFO sitting at 2.74, resulting in a payout ratio of 67%, which is below the average for REITs, so this is looking really good. The credit ratings look pretty good to me as well. I prefer A ratings in most cases. And in this graph we see the NOI breakdown. US malls and outlets is by far the biggest segment with 72%. And to me, this is something that I don't really like. With the booming e-commerce, people don't visit the malls that much anymore. Outlets also have less visits in ratio than before, so it's a declining industry. And although it can be a good thing to focus on only one industry, in this case I think it's not a high growing business in the future. The last thing that I want to check are the fixed charge coverage numbers. Right now it's sitting at 4.6, which is a great number in my opinion. I prefer 6 or lower with this company. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue diving into the fundamentals. Simon Property is a 33 billion market cap company. And since this is a REIT, I don't want to focus on the PE ratio and use the price to FFO instead. Right now it's sitting at 9.6, which is a really low number and could indicate that SPG is undervalued. Later in this video I will show you my 3 price targets for SPG, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 5.3 billion, and in this graph we see that revenue went up and down quite a bit in the past couple of years. Ever since the lockdown periods, the revenue didn't hit all-time highs again. So this company is struggling to recover as more people visit online stores, as I said before. Over a longer period of time, margins are going up, which is very nice. With a declining revenue, this is very important. Analysts expect EPS to grow at low single digits. For the revenue, it's pretty much the same story, so not a lot of excitement here. Return on assets is sitting at 8.4%, which is below my 10% minimum. But for a REIT, it's looking pretty good. Return on equity looks also really good at 70%. The most important number, return on invested capital, is sitting at 8.2%, which is a really good number for a REIT. It's slightly higher than the 5-year average, which is also very nice. Current ratio is at 1.43, which looks pretty good to me. For this type of company, I prefer a number below 2. Total debt is sitting at 26 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now, total cash is sitting at 1.16 billion, so they cannot pay down a big chunk of their debt, which is something that I don't like. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in here we see that free cash flow is going up quite nice and steady over a longer period of time. Of course, there was a decline in the lockdown periods, but for a REIT it looks pretty impressive. And the thing that is also very interesting about this company are the shares outstanding. It's going up in the long run, but not as much as with other REITs. And REITs issue new shares to raise capital and grow the business, so definitely a number to keep your eye on. Next up are the dividends. Dividend yield is sitting at 7.2%, which is a great number. Annual payout is at $7.4 and payout ratio is at 67%, as we saw earlier in this video, and not the 119% displayed here. That is because REITs use FFO to pay out the dividends. The 5-year growth rate is nearly flat, so that's a bit disappointing. However, with dividend yield sitting at 7%, I think it's all good. And in this graph we see the expected dividend in 2023, 2024 and 2025. Of course, this is an estimation and can be highly impacted by results, but it gives you a rough indication. Analysts think dividends will increase a little bit over the coming years to $7.86 in 2025. Overall, these dividends look pretty good to me, but how about the historical returns? I decided to compare SPG stock with the overall market, in this case the S&P 500. Next to that I added some other REITs with Realty Income, Kimco and National Retail. On the 5-year chart we see that SPG had a minus 18% return, underperforming the S&P 500 big time, which returned 68%. And keep in mind, this includes dividends. So even with dividends, SPG returned minus 18%. The other REITs also underperformed the S&P 500, also because of recent events. On the 1-year chart it looks pretty much the same. SPG returned a negative 4% while the S&P 500 returned 5%. All the other REITs again underperformed the S&P 500 as well. On the 6-month chart it's again the S&P 500 that is the big winner, with most REITs return a big negative number. And on the 1-month chart you can guess it. It's again the S&P 500 which is the big winner here, with 3.8% return, while all the other REITs have lower returns. N is the only one with a positive number, in this case 0.4% return. So bottom line, SPG was not the best investment when you compare it to the S&P 500. And again, keep in mind this is including dividends. So could this mean that SPG stock is a buy at current numbers? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 0%, 1% and 2%, since I think they will increase the revenue at roughly the same numbers versus the historical averages. Next to that, it's also based on the analysis expectations and the current outlook. Profit margin I'm filling in 38, 40 and 42%. And for the free cash flow margin I'm filling in 52, 56 and 60%. PE ratio isn't the best way to value a REIT, so I'm just putting in 20. and for the price to free cash flow I'm putting in 12, 14 and 16. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5%, but I want a higher margin of safety with this company. Right now SPG stock is at $102. I hit analyze, and we only see red numbers. I'm not focusing on the multiple earnings value, but only on the discounted value. We have a low price target of 67, which is a big drop from the current stock price. We have a mid price target of 83, and we have a high price target of $101. To me, the mid price target is the most justified here, which is a decent drop of roughly 20% in stock price. Right now it's overvalued big time in my opinion. My final conclusion on this stock is that I do like to see the industry focused companies, but not on this industry. I think it's a declining business and a lot of fundamentals show me that it's indeed a declining business. Besides these growth numbers, other things look pretty good, like debt, margins and dividends to name a few. For now I'm skipping this stock for multiple reasons, but the main issue being a declining industry and lower returns versus other stocks or the S&P 500. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.